So I'm going to record this, and that recording has started. And, this is a interesting period. Let me connect the presentation. I'm just going to go right with it. There's a bit to go over, and hopefully we're having other people join. But today, the question right now is a hard landing or soft landing, an economic recession, the great rotation, geopolitical risks, where will earnings bottom? What will be the impact of persistent inflation? And I'm wondering whether China's zero COVID will be a big factor.
Dan, I think we're having some audio issues, so we're going to get that sorted out and come back to, we're going to go to a quick break right now. And up next, we've got exclusive results. We're going to.
Who that is? Oh, that Tony, I put you on mute. I was hearing some background noise, actually talking about audio, but that was probably on your TV. Anyway, so can everyone see the picture here of my PowerPoint? Earnings turning down. Everyone's muted, so it looks like I got a nod from Jennifer. Okay, great. So I love this chart. It is a Fed model. It's a risk premium model. And when you look at it, it's really important to track, in my opinion, how much earnings declined in 2000 and 2008, and the 2020 decline, the COVID crash, as I like to call it. Trying to figure out how to manage all the attendees. Okay, but what you see here, I'm going to try to expand it a little bit, is you had very sharp declines in 2008 and the COVID crash, but in 2000 and 2003, the decline was a little slower. And my sense is, what's going to happen here? Earnings have rolled over. The question is, hello, Chris. But, we will see. So yesterday we heard Jerome Powell speak. He talked about a 0.5% GDP growth, which really surprised me because I think a lot of people are looking for, a real slowdown. One of the new items they're talking about is the potential impact of ending zero COVID in China and being the second largest economy in the world. If that were to start to kick in, maybe that gives us some legs as things should continue to weaken. Jay Powell, I just said, talked about 0.5% GDP growth. Somebody is not on mute, so I'm going to mute them. I think that might be you, Chris. But also Christine Lagarde also talked about 0.5 GDP growth in the EU, which I was talking to Rich this morning, and that's kind of extraordinary. Jeff Gundlach, who I think is one of the giants in terms of understanding the market, and he says there's a 75% chance of a recession. I think most people would say that's probably true, but when I think of a recession, I'm not thinking of something that ends up with 0.5% GDP growth. And then you've got Williams, a Fed governor out of Richmond, and the economist William Taylor out of Stanford University. They're talking about, and I think some other people, and I think people don't want to admit it, that if this inflation is persistent, we're going to have to tighten a good bit more. And this idea that things kind of stop with, a 0.5 or 1/4 point more doesn't sound very plausible. And it could be as much as 6 to 7%. So on to the next chart. I'm talking to myself, of course. The issue is last year was pretty. Hi, Walter Harrison.
Hi, Tyson.
This last year, it's not over, but I'm calling it this last year, was pretty brutal. We had some very serious declines. bonds got really smacked. The whole yield curve has shifted quite dramatically. And, how much more damage can we sustain? In my opinion, I think that there's a lot more downside risk. And using the Buffett model just to get back to normal is 26%. And sometimes in severe declines, such as what we saw in the 70s from, let's say, the 66 peak, or when you look at it from the 2000 peak to 2008, you went from 2 standard deviations above down, and then even another standard deviation or 2. Hopefully that's not the case. We will see. Okay. So one of the real issues that everyone has to get their brain around is inflation. And inflation is the problem. And how we even measure it is a little confusing. But I pulled up the PCE, which is reputed to be what the Federal Reserve is most focused on. And it got to 7%. And yes, it's tailing off. And in my opinion, for it to get back to 2%, I'm seeing a lot of people speak awfully optimistically about it dropping back. But I think that energy prices will remain elevated. I think that there is a risk of wage pressures. You still have massive government, fiscal stimulus. There was a monetary stimulus. There's a lot of regulation. And I think that would keep inflation higher than expected. I wouldn't be surprised if it's 4% or 5% and then continues to decline. But I don't think that we're going to easily get back to 2%. Another problem is the Fed balance sheet. It's enormous. It's I think it's around $8 trillion, and it is ballooned massively, kind of creating this bubble across a variety of asset classes. Ari Wald has made some very good calls, and this is one of his charts. We've come back on a technical basis to a rising to a trend line. So we should get a bounce in around here. And I think that he has an index of stocks, the number of stocks above their 200-day moving average. And that went from a peak, got really oversold, and it's recovering. And what that suggests to me is often you go from an overbought to an oversold here, and you still have probably more room to run. So I'm optimistic into January. I think the real takeaway here that I want to emphasize is I think we're in a rotational environment. And I'll talk about that. I think one of the issues is interest rates have declined for 40 years. And I think that the market leadership has changed. And it is no longer tech. It's no longer FANGs. It's no longer the triple Q. And you want to be in value, commodities, precious metals, emerging markets, and away from long duration assets, specifically long bonds, growth stocks, tech. And I'm going to share something that people who don't know me well may know vaguely. I once ran a hedge fund in 2000. It's set up in 1999. I had made a great deal of money for my clients in tech. And this is what frames kind of how I think. For a brief period, I killed it. In 5 months, I raised $12 million. It went up to 24. If you look carefully, I actually pulled this today. It's kind of a painful lesson, but I actually got out at the top on March 23rd. I had a technician who was a CFA, worked on the floor, very astute, said, all the tech stocks have gapped open. That's a sell signal. Get out of tech and don't get back in. And I actually made money that March and April. Bob Farrell, the market strategist over at Merrill, said, you were the only tech hedge fund to make money both in March and April of 2000. But so I was up in 5 months, 112% gross, making money I'd never made before. But the reality of it was I wasn't used to a bubble, and I think I am now. And I think the real takeaway I have down here is in the 8 years after that, had I moved into energy, emerging markets, precious metals, materials, values, small cap, and completely abandoned what all the old winners were, I would have done very well. And I think that that's really the takeaway today. And so these charts will show that. What I've shown this often because I think it really makes sense that there's a way to look at the market in terms of cycles. And I would say that we're in an inflationary cycle. And right now, this says deflation, but the ratio of the S&P divided by the PPI, a log index, actually has turned down about 5 or 6 months ago. And frankly, we've been watching energy already have a big move. But you have distinctly different market behavior during deflationary environments. That's when all the long duration assets do well, and inflationary. And I didn't realize this until kind of looking at this chart that from 2000 or 1999 to 2008-9, that was really an inflationary period. Oil went from about 20 up to 147, and materials and energy and small caps and emerging markets, they did well. This is very much like the 1970 playbook. Gold you wanted to be in energy. And I've described this as the great rotation. And Jeff Gunlock, who I've mentioned previously, talked about this ratio, which I have shown here, which is the S&P divided by the CRB. And during this period from 1999 to 2008, you had the CRB taking off. And the whole point was, and he said this, he said, basically you can get outperformance on the order of 700 to 800% by rotating into the CRB or commodities and having that kind of orientation, which of course is hand in glove. It fits perfectly with the idea of an inflationary environment. However, in the deflationary period where oil prices started to decline from 147 all the way down to negative in the March of 2020, you were in a deflationary cycle. Then it was time to get back into tech, and history has a way of repeating itself. I tried to do some quantitative work, and I think this really is worth repeating. And if you take a look at the XLE, the energy index from 1999 to 2008, the energy index was annualizing 22%. And the triple Qs, now granted, this included the tech collapse, average minus 3%. That's a delta of 25% on an annualized basis, and that's enormous. And so reallocating, I think, is really critical. And during the deflationary period I talked about, where from 2009 to 2022, the triple Qs have annualized 20% on an annualized, but the energy index, the XLE, only returned about 3.6%. So again, just switching from one sector to the other can have a huge and positive impact. One area that I think really makes a lot of sense right now is gold. And there is a correlation of gold to the dollar. And when gold is strong, the dollar is weak. We saw that. This chart didn't go back all the way, but you had a nice run in gold up until 2012. But then the dollar has been strong from about 2011 till recently, when I think it topped. And during that period, gold actually was weak. I'm going to have Mitch Balajic articulate some thoughts on gold in a bit. But this is a chart of the GLD index, which is basically the metal. And what it shows is you had that run that ended in 2012. And you had a big saucer. It started to break out and recently pulled back over the last 9 months as the Fed was tightening. But with the expectation that the Fed would finally back off, that leads to the dollar weakening, and gold has rallied. And I've mentioned this in some last calls. And so I've gotten long gold and it's felt pretty good, though today it doesn't. So in my opinion, gold is ready to break out. I know Rich Gula doesn't necessarily think so, but in my opinion, if the Fed can get on top of this inflation issue, I think gold could go a long way and quite substantially. I have another chart here showing gold and silver significantly outperforming, in the 2000 to 2011 period and going into a big bubble. And I think that that's precisely the period we're in, where you had a bubble and then things kind of settled, and gold and silver actually became very popular and they had big runs. And I don't need to remind people that in the 1970s, gold also took off incredibly. It was actually, I have it down here. It was actually up 2,000 to 1,500%. And the Bass brothers tried to corner the market on silver. And, that was that. Then you knew that was the end of that bubble. But in my mind, it seems like commodities may now be peaking. Clients of mine, people who have been following my, very focused energy strategy. We had a great period from about March of 2020, the COVID crash bottom, till maybe May or June, at which point oil prices started to abate, natural gas, and the whole energy complex pulled back. And the CRB index here, in my mind, looks like it's starting to turn back up. I'm hearing of a China recovery. Bank of America says oil prices ought to be 100 all next year, and that ending at 110. I think that's consistent with Jeff Curry over at Goldman Sachs. Another chart that I think makes sense is during the bubble in 2000, growth significantly outperformed relative to value. And then for a period about 5 years, and I think that's what people need to keep in mind, you want to stay away from growth. And I think right now we're going through a similar bubble in growth and shift to value. But I think that we're going to see this trend persist for a while. Another thing that I had observed in the aftermath of my hedge fund experience was that I should have gone into the emerging markets. And it's hard to see here, but I'll try to make it a little bigger. But from 2001 to 2010, that was a great time to be long China and the emerging markets. More recently, it hasn't been, but I'm wondering whether or not we could actually get a tilt back to the emerging markets. And that is kind of what I want to monitor. I was talking to Kevin Delaney, who's on the call, a former JP Morgan institutional guy, saying, there's really a lot of value in energy, and mentioned putting together a portfolio with emerging market debt. And I really think that makes sense. So I'm done, and now I'm going to go over and have Rich Gula go through some charts. Rich, as you know, consults. I hear somebody in the background. Anyway, Rich consults, maybe that's Rich, to 6 Fidelity guys. He set up the chart room at Fidelity. He's a brilliant guy, studied psychology, undergrad and graduate at Harvard, worked for 2 icons in this business. Dean Barron, a great pioneering quantitative strategist and indexer, as well as Ned Johnson, who we worked directly under doing special projects over at Fidelity. So he knows everybody. He knows.
At that table any longer?
What's that?
Are you going to be sitting at that table?
Yeah. You can sit there. You can sit there.
Oh, okay.
Anyway, good morning.
Good morning, Rich. I hear somebody wants your space. We'll
No. I'm sharing. That's how you meet people around here
Okay.
after COVID. Everyone else is hiding under a rock or some other object.
So
No.
I can you see the screen? I just went through your bio quickly, but the bottom
Yes.
line is Rich has a great understanding of who the players are, where the big money is going, and he has some very interesting insights. Go ahead, Rich. We're on slide 1. We're looking at a mortgage ETF.
Yes, one of the unwritten stories that's out there right now is that if you notice the circle under the B there, there's a gap in this chart and there's a huge spike in volume it was in October, a little bit after the 12th when a lot of other things bottomed. I've been watching this all along because of a very interesting early morning commentary with Brian Sullivan on CNBC with a old-fashioned mortgage guy, semi-balding. I like balding guys because I'm old, and he basically said, "Gee, Brian, it's interesting out here right now because mortgage rates are up." Ostensibly, this conversation was about housing, mortgage issuance, and whether there'd be drops in prices in various markets. And he said, "Brian, it's interesting. There's no bids on these 3% mortgages right now." And Brian just had that look of Steve Leisman does it better on CNBC. When somebody says something, he'll give a blank look like, "Oh no, we have to talk about that." And Brian said, "Oh," and he said, "What's the implication of that?" And he said, "Those 3% mortgages are in every income fund." And then I looked at all the charts of all the ETFs, and boy, they were all crashing. This chart doesn't do justice because it's daily, but if you put up a weekly on the MBB or the BND, it's the very large Vanguard $83 billion fund. All of a sudden, why would everybody buy it on that day? I think there was a problem out there. That was just after the pound had its problem and got down to 103, and BlackRock seemingly, supposedly, what LY word you want to use, got in touch with the chancellor of the Exchequer in London and said, "If you guys don't do something about your bond problem, we're not making a market tomorrow." And that meant they were stuck. That's kind of interesting stuff. And it reflects one problem, I think, with the Fed. A lot of my friends are lawyers, but having a lawyer running the Fed is a tricky business. And I don't think that BlackRock would have said that without permission from a Paul Volcker or a Bernanke. I think that there's some looseness in the system, but all said, there's still a problem out there in these bond funds. I don't know what exactly it is. I just think that you don't have a 103 to 122 move in the pound, a big move in the yen. The euro was heading for 90 where it started, and it's now 102, 104, wherever. So net, this is sitting out there. And why it's important is that the way you would solve this problem in modern red telephone days, in the G10, G7, G whatever, is you create liquidity somewhere and flood it into the market, but not have it be in the sense of buying bonds like the ECB was for a long time. Also realize that this chart was colliding with the Fed's declared intention to reduce its balance sheet. And a lot of what they own were mortgage-backed securities. So whether they're going to sell it into a trough. Anyway, file that away. If this chart continues to improve, I think that we're going to survive it okay. But I think there's a lot of money in the system right now that is going to bet somewhere. And a dollar bet is better than a yen bet or a euro bet or a pound bet. Anyway, next chart. It means that you could have a rising market here for a while that's going to resemble a short squeeze, but it's not going to be one. I'm just going to flash through a number of consumer stocks that have done very well that are not consistent with a recession. So Estee Lauder, number one. Next slide. Nike, which was the Nike chart is devastatingly bad if you go back on a weekly, monthly basis. All of a sudden it reverses and these stocks are moving up 30%. Next slide. Then you have the sort of what I call the adults in the room investing, meaning the guys at Deere and Caterpillar are still running some kind of a pension plan, and they're probably buying stocks through value managers, a la Tyson's chart before about value versus growth. And lo and behold, if inflation's terrible, I'm not sure Hershey can make a lot of money. I know I don't buy Snickers bars anymore because they gotten too expensive, but that's a whole other story. Next slide. Tapestry up 36% off of that low. All these lows came in that October, November time period. Next slide. Good old fashioned Coca-Cola, which is still a good staple stock. You got a 3% of that in a portfolio and you're a lot happier than if you got the 3% in NVIDIA. Next chart. Then here's the ETF, which interestingly, let's see now, this is a daily and somebody's trading what? Is that 13 million shares a day, Tyson? Yeah, that's
Yes.
13 million shares a day. Who's trading 13 million shares a day of a staples ETF? Except that tells you there's liquidity in this part of the market and the asset allocators are going here regardless of what they may be saying. Next chart. By the way, if you want to go and then spread this out, they got to save the ECB. They got to. I love Christine Lagarde. If you guys have guys and gals have followed her during her career, she's like just such bad news for any women that have to go out to dinner with her because she's the best dressed person in the room every single time, and she really is smart. And you may recall Smith College didn't let her speak at commencement because he was the head of the IMF. And they felt that the IMF was a cruel place. And so Smith College lost 10 internships over at the ECB. Not such a good choice there. But I love Christine, and she did a great press conference today. And lo and behold, I would be interested in cherry picking value stocks all over Europe. SAP is a good one, but ASML is a little more aggressive. That's on a lot better than most of the US tech stocks have, even though there's some cross currents with the Dutch telling them they can't sell their chips over there in China. Next slide. And this is the Stocks 50, which is the closest thing we have to a S&P 500 in Europe, at least to my mind, in terms of liquidity. Same pattern. These stocks have gotten higher than they should have if it's just a bear market rally. There's been good support, and all of this started back there in October. Next chart. And this is one of the things you do to keep yourself from believing what you're saying, which is always a danger in this business, as we all know. This would be the counter. If I like this chart, then the market's going down because this is the ultra short QQQ, which somebody trades 10 to 15 million shares a day in this thing. And I have a problem with that chart. It looks to me like it wants to go down. And I'm hoping I'm not seeing, because I see these positives elsewhere, but I've got to keep an eye on that. And I run a whole pool of these inverses. It's a whole portfolio. So when that looks bleak, things are good. And when that looks good, I got to be careful. Next chart. And then we're going to look at a couple of bond charts. So the spread is over to the investment grade bonds as well. Yeah, there was a gap there too. Notice everything spiked on volume on the same day. 17 million shares a day in a bond fund during rising inflation. So by the way, the thinking on this from some old timers that I talked to was, if when things are coming down, somebody is a buyer because they think they're getting a good deal. If they go down a lot, somebody's now stuck. And how stuck was somebody in that MBB area, in the mortgage-backed security area, and what's the implications? Because there's a world of derivatives out there that trade off stuff. Next. By the way, junk bonds, and the next chart as well, the high yield. Next chart also, Tyson. Both of these guys have never been under the same pressure, which doesn't make any sense. It seems to me, having been on the side of a bad bond fund way back when currencies were not part of the euro, if you sell your good stuff first, there comes a day when bad things happen. And you would think that you would be coming out of your high yield and staying in the LQD and the AGG. And it was not, that's not what happened over the last 6 to 9 months. Next chart. This is where I offer the contrary perspective on what Tyson was suggesting in terms of earnings. I go back to IBES. They walked in, the guys who invented IBES came into Battery March in the 80s tried to sell it to Dean LeBaron and as a subscription, and he said he'd only take it if he could have the disc, so nobody else in Boston could get their hands on it that day, which is the kind of thing Dean would do just to jab at the other firms, especially Jeremy Grantham. There's an unpleasant history there between the two of them. Anyway, these IBES numbers aren't coming down, and 4,600 I think is 20 times like 220 or 230. I can't remember. I was supposed to put that in.
20 times 230.
20 times 230. I can't see it on my slide, but the next slide then. So if in fact you don't produce this decline in earnings for some reason, and I'm only offering that up because the strong consensus from a lot of very, very substantial research people, this isn't belittling the opposition, so to speak, at all. You could have a much higher forecast in the S&P for next year without it being completely outrageous. And this is the chart that the old timers look at. They like 4-year lows. So the V's are picking up 4-year lows, and you'll see there's after the second V, this is the S&P going back pretty far. I can't see the bottom, 1994 or so. Notice that there's kind of a funny low there and then a reversal. And that was the beginning. It's sort of, it would have been in 2010, Tyson, if you could put the cursor there, like in the next line over. The drop, yeah, that one there. That began a period where I think cycle valuation studies didn't work very well. Remember, you got very trended, and for all those years, even though you'd have drops in the market, you just kept going up. However, if you use any kind of a little slow moving momentum model, you just want to see the trough and then look for a reversal. And the next trough on a 4-year basis was in 2020. So you can make an argument from the wall chart that we got another leg of a rising market here before something happens on the downside. That's not consistent with anything to do with the quantitative easing and Fed policy and rate rises and so forth. So, welcome to the world of conflicting data. And, it's beginning to resemble the NFL season this year. By the way, I had a coach tell me 25 years ago that when they went to modern artificial turf, they would change pro football totally. 2 ways. They would make it a speed game, and number 2, they'd increase injuries by 50%. And I think he was pretty smart. And I think we have a speed game now with derivatives. There's apparently $1 trillion of stuff that is unraveling on Friday. And this was rollover of the futures week. Why the Fed would do an announcement on rollover the futures when the 10-year future has just gone from 455 to 445, 345 is beyond me. But God bless them. They truly are oblivious to what's going on in the markets. And do I have another slide?
No.
Okay, there we go. Last comment is Fed funds in 1984 were 12%. I think in 82 at the famous Volcker rate cut day, they were probably close to 16. Whether we go to 4.5, 5, 5.25, I'm not sure is a big deal longer term. And then last, Lisa Abramowitz on Bloomberg yesterday was doing the commentary on the Fed announcement and the press conference. She picked up on something Chairman Powell said that suggested to her that 2% was not a dyed in the wool, cast in stone number. Maybe it's 3% or 3.5%. And that got everybody at Bloomberg really upset and happy and upset. So go figure that in terms of what Fed policy really is, with 17 of the folks betting over 5% now in the voting. Anyway, thank you, Tyson. And I think that into the end of the year, you got a shot at upside. I think that the last day of November was a November massacre for everybody who was a macro bear, because it flipped the month positive, and a lot of people are going to be writing quarterly letters and annual letters of 5 bad quarters in a row, no matter what they were trying to do. All right, thanks a lot.
So we sort of have about 5 people who used to go to the Brimberg lunch. And a few other professional money managers. And so I'm going to pick a couple people to speak. It'll be Mitch, then Tony, Jennifer, Kevin, and then Walter, but to get some comments. Mitch and I have been chatting about gold, and I wanted to get his perspective on it. I'm of the belief that there could be a very significant run here over the next, let's say, 6 years. And since I don't know what's going on in the stock or bond markets, they may actually do well, as I tried to show in some of my slides. Mitch, go ahead. And Mitch, by the way, worked at ITT. Go ahead. Mitch, can you speak? You're on mute.
Yes, right there. Can you hear
Coming
me?
from outer space. Go ahead.
Well, that behind me reflects my state of mind as far as markets are concerned. I feel like I'm really in a parallel universe with everything I'm seeing and watching right now. But let me just kind of continue what I left off. You asked me about gold. I'm looking at kind of very short-term frequencies. As I mentioned, it was really a dollar watch. Dollar goes up, everything goes down everywhere around. Right now, I really don't have an opinion on what's going on, but a couple of observations that I see. I have no idea when I listen to, and I intentionally listen to Bloomberg, reads different market analysis, whatnot, just to see how opposite and clueless people are. And that's where we're heading right now. And I have no idea where people get their earning estimates in this market environment and how they come up with these precise charts. I really have no clue. And I absolutely don't believe in that either. But one thing that I tend to believe and focus on closely is what the market, including the Fed, is telling us. I mean, what the participants are telling us and where the trades are really happening. So between the inverted yield curve, contango in the oil markets and whatnot, I tend to believe that Fed is telling us one thing and the reality is totally opposite in my view. So the problem with gold, again, gold is a good asset, but it's always relative to the dollar. So you might have a little bit of consolidation here, but eventually it's really a dollar watch and what the market does at this point. But I'm also, one thing I watch very thoroughly is like have my crack watch, not meaning the drug, but meaning like general markets and what's happening, whatnot. And right now, my biases that I see are very clear right now, knowing the UK market and the British pound. I'm definitely extremely short in the British pound because it just happens to be that the European Central Bank is getting a little bit more hawkish than the UK Central Bank. I think UK is in deeper trouble. So basically, that is pretty much my hedge with gold. I like going short the British pound, long the gold, because I think relatively that trade is going to work well. Everything else, I'm really on watch, and I'm generally still very bearish. And one of the things that's really troubling me is the metals market, and not meaning precious, but just meaning metals like copper and whatnot. Dr. Copper, as they called it. I think copper is entering into a really serious bear market in the next few months, which is really the sign of our times. So not much from me right now. I'm just kind of really on the watch, but I'm still looking long gold, but I'm hedging it with selling the British pound. That's the only things I'm seeing really clearly now. And I'm very uncomfortable with the derivatives market and the euro dollar market, which I follow very closely. There's a lot of problems brewing there in respect of liquidity defaults in a market that no one really knows what this market is. Bank of International Settlement comes out and says, hey, we just found $80 trillion. I can't even remember what number that's out there, but not registered anywhere. So I really have to watch closely what the bond market is telling us. one thing and watching the dollar. But right now, that's my only trade. That's the only thing I see that will be working. I think British pound is in extreme pressure. I think it'll be very close back to par with the dollar. It doesn't make any sense being at anything north of 110, not to mention 120. And the gold eventually will do okay, but it's a dollar watch.
Thank you. Tony Lobier, will you kindly share your views and see whether I can get you unmuted?
Okay, I have a different view from most people. First of all, I think the Fed I think these guys are either lying or they're totally out to lunch, because they're trying to, how should I say, manipulate policy, looking at two lagging indicators. And that really makes no sense at all. They're supposed to be predicting things and not looking at lagging indicators. The other thing I think is that the Fed cycle will not be ended by any kind of recession, although I think we probably will have a recession. What's going to end it is some kind of disaster in the financial market, which was alluded to earlier, because there's just too many loose derivatives, too much debt, and at some point this is going to blow up. The third thing I'd mention is that given that we have several inflationary trends, which together indicate that we won't get back to anything close to 2% for quite a while. The first one is this war in Ukraine, which I think is totally crazy. The other thing is that we're trying to eliminate fossil fuels. And this is, however you look at it, and whether you're for it or not, it's going to be an extremely expensive proposition. The third thing I'd mention is that at some point, as interest rates go up, the US starts to look like a bankruptcy. And so I don't think, I don't think that the Fed can do all that much more. And the other thing about the Fed is that I think a lot of what they're telling us is not a real prediction. It's what a friend of mine termed open mouth operations, which means they're trying to influence the market by what they say or what they call as a prediction. And I think that that's in the long run, that's a very dangerous concept, because you lose all credibility. So I don't know where I stand. I think this is a trading market. I think inflation is going to stay much higher than people think, although it probably will go down from current level. So I guess what
do you think of gold?
I like, I like gold, I like silver, I like platinum. And the other thing is, at some point, we're gonna have to rebuild Ukraine. And that is going to be extremely expensive, especially in terms of commodities such as copper, steel, and God knows cement, and God knows what else. So, you know, I think it's a really interesting time because I think that the market has it all wrong. And I haven't done this, but I think that the biggest shorts are some of these consumer staples long-term, because I remember in the late 70s, early 80s, Merck sold at 6 times earnings and nobody would touch it. And so I think that's going to be true of a lot of these consumer stocks like Coca-Cola, for example. The other thing is I offer is I think Elon Musk has completely lost it. I think there's a real danger that he may go bankrupt because there's a lot more competition in the market, and he's taken his eye off the ball, and he's created a lot of capacity, but he's not improving his product. And you know, at least on paper, I look at some of the things that GM is talking about, and they look pretty interesting. So, you know, I think we're in a very difficult time, and you better, you know, watch very carefully what you're doing. I like gold long term. I like silver, and platinum may be the cheapest of the lot. So, you know, it's going to be fun times. I also say I also really like Argentina, which is a totally contrary call. And the reason I like Argentina is because the country, though it's totally screwed up, produces enormous quantities of natural resources. They have an election next year. This government is very unpopular. It will probably be voted out. And you take a stock like, and I'm just using this as an example, but when Macri was president of Argentina, Banco Macro sold at 11 times what it's currently selling for. And so I think this is a really interesting country, even if they lose the World Cup.
And you like YPF as well for
Yeah, well, YPF is my favorite stock and by far my largest investment, because I think they have enormous resources. It's incredibly cheap, and I mean, it's crazy. I mean, the government is spending billions importing LNG from Bolivia when they have this stuff in their backyard. Now, admittedly, it's going to take infrastructure, which is not that easy to get in Argentina because it costs money. But they're talking with Petronas about building an LNG facility. They also appear to have finally gotten permission, although I'm not. You never know in Argentina, but to drill offshore, and there are huge basins offshore Argentina. So anyway, you get all this for a stock that's trading around less than 2 times earnings. And not only that, you have a universal situation where Goldman Sachs, JP Morgan, and Morgan Stanley all have stock recommended as a sell. So I don't get it, but at some point they're all going to reverse themselves at once. So
That's great. I'm gonna switch the order that I said previously and ask Kevin Delaney whether he has any comments.
Hi, Tyson. Can you hear me?
Yes, we hear you loud and clear.
Yeah, Tyson, I guess we've spoken in the last week or so about my views. I think it's not that complicated. I think the bond market is telling you what to do. I think the 2-year treasury, the 10-year treasury are moving lower, higher in price out of the belief that inflation has peaked. I think to the earlier comment about the Fed, I mean, Powell has to jawbone. He has to talk tough. I mean, if he's dovish, the markets are going to rally. So yeah, he's jawboning. I think he's supposed to do that. I think he's going to stay the course longer so he ensures that there's not a reemergence of inflation like we had in the 70s. He's fighting to maintain credibility. He's hurt himself by the earlier narrative that inflation was transitory. I mean, that obviously was flawed. So if you look at treasuries, you look at the dollar prices of treasuries, if you look at spreads in, single B, triple B, double B corporates, I think they're attractive. That chart that was up earlier, that Rich had, where high yield had rallied, I think, high yield had gotten oversold. People thought it was attractive. They went and they bought some isolated credit investments. I think Gunlock was alluding to a trade that he did in the space back in October. So, I don't know what else you want to hear from me, but I think it's going to be a stock picker's market. I think bonds are going to serve you very well. If you think we're going to go into a recession, I think you have to monitor what the data is, but obviously you want to be in treasuries if that's the case, and go out of treasuries later in the year and go into a widening high yield bond market. But anyway, as far as stocks go, make sure you know what you own. Make sure the valuations are reasonable. Make sure they can protect their margins. And in terms of Elon Musk, I think the guy's a hero. I hope the market doesn't take him to task over what he's doing with Twitter, but I have tremendous admiration for the guy. So maybe that's it, unless you have any questions.
No, that's great. I just, some people here I know have a great deal of experience, you being one, and I just wanted to get some other views than Rich's and mine. I'm going to ask one other person to speak and then just go to some questions. Jennifer Warren is a consultant. I've known her and she's spoken previously. Do you have any comments with regard to the energy market and what you think? I know I've emphasized the importance of energy oil's come down. What are your thoughts? Quickly.
Well, I've been doing a lot of delving and, a lot of research on the energy transition and what the bottlenecks are in spite of the IRA legislation, which is, 360 billion that's targeted towards green initiatives. And in spite of this, I'm still very bullish on oil and gas. Fundamental. If what everyone's saying about earnings is correct. And also I've had this accounting professor I've worked with also discuss that the earnings all came in reasonable, not, no surprises, sort of things that I think Rich was talking about. It's looking a bit steady in spite of recession talk, and also with China talking today, even in the Wall Street Journal, about going back to 5% growth. Now, basically, they're saying we're going to ramp up, and what that really means is hard to say. I mean, it's a signal, but they've also been signing a lot of large deals with Saudi Arabia and Qatar on oil and gas, huge deals. And, that's also indicative. So there's a floor, there's a secular floor. And what I think Rich was saying about emerging markets, or maybe it was you, Tyson, I can't remember who, that's where a lot of the growth is, right? For oil and gas. And so if that's the case, it's the demand is not going to decrease. And we still have the investment supply constraint headwinds of all these producers, whether it's US, OPEC, NOx, non-OPEC, call it whoever you will. There's a ton of participants that are not going to ramp up oil supplies. They're going to stay constrained. They're going to keep prices at a floor. And in spite of the green push, I think there's a lot of rethinking because of the energy security issues, because of Ukraine and Russia. That revealed a lot about the need for reliable sources, which are baseload, and renewables don't provide that. Even if you add battery storage, and you're talking about a lot of new investment to do that, and you're talking about a lot of minerals and mining to do that, I don't know, it's not going to move that fast anymore. That's my assessment on the energy transition. Not going to move as fast as everyone thought it was going to move. That's psychological. It's not going to happen. It's not reality. And if anything, the Ukraine-Russia situation proved that. You now have Germany building all this LNG capacity. Now, yeah, they're trying to redress that Russia has been a key supplier of theirs of natural gas, and they're obviously diversifying. But it's also indicative of them knowing that they need steady baseload. That's natural gas, and that they can't, that coal is it's going to decline over time. It just is. It's because of the pollution, because of the emissions. And so natural gas is the go-to solution. Today, even natural gas, I was looking at my stocks, the natural gas stocks were the one things that were holding up today. And so I'm trying to think if there's anything else that anybody said. The Argentina comment is interesting. I point to the Vaca Muerta in Argentina. I wrote about it a long time ago when I was looking at shale resources around the world, and CVX was a big player in the shale play, the Vaca Muerta, which is a big natural gas play. And yeah, Argentina has a lot of energy transition, type of minerals. There was something else somebody said. Also, I've noticed, and because I was asked to comment on this, there's been some new IPOs in the energy space, and one of them was a Permian player, and two of them were natural gas plays, one of them a minerals trust. So I thought that was really interesting, because if these firms, and obviously they don't want to take on all the debt's out in, oil and gas, right? So yes, they would go to equity markets, but it's also, to me, a little bit interesting that is happening amidst all this, uncertainty that those IPOs are happening. And so, yeah, I agree. There's some disconnect between, what the market signaling and what's really happening. And you see that playing out in oil. Gas is a little more revealing, I think. So that's what I would say.
Thank you. Do we have any questions? Might have to unmute yourself if you want to speak.
Tyson,
Go ahead.
I just have a question. A lot of what I'm hearing today talks about history and this happened before and whatever. I just two thoughts. One is, I think so much of it is now caused, you can't go back to history so much, because the things that are happening today are all artificially induced. I think what the last speaker just was talking about in the oil and gas is indicative of the whole thing. I mean, here's a thought from me, and I'd love people to comment. The fusion thing that happened yesterday, my view is that could destroy, and should have, if people thought about it, the entire green energy. Are we going to spend trillions of dollars reducing our GDP globally around the world so that we can reduce carbon, when the solution has to do with fusion? And we'll wake up 10 years from now in a much poorer universe saying, what the hell did we do? And I'm writing a piece right now, which is going to compare it to something that happened 100 years ago. If we're up to the government of New York City, we'd still be fighting of how to get all the manure out of the city, with all the horses and the development and all the manure. And they'd be still fighting on how to get rid of the manure, when it's going to turn out that the automobile had nothing to do with getting rid of manure. That's what the answer was. And I think the world's a crazy place. And I think it's more important to watch what the players in this world are doing to artificially screw up the markets, than to try to think about the markets, what the markets would be doing if they had a rational market to act in.
I think that's a brilliant point. I think that the only issue is the immediacy. I think in the near term, there's still money to be made in conventional oil and gas. But I think that assuming energy is like biotech, we need to see the proof of fusion thus far go another step in terms of commercialization.
No, but my point is different. My point is, this is what's bullish for oil and gas, because knowing that you've got fusion in the background, you want to, while you're waiting for fusion to happen, you want to be in fossil fuels, because you're not worried about how carbon's going to destroy the world anymore, because it's only a limited term thing. But green energy is a disaster, because it's not going to give you the solution. And in the interim, it's going to destroy economies. So oil and gas, fossil fuels are the answer.
I like it.
Yeah, can I just say something, Tyson? Because I've actually, this is what I've been working on for the last month. I've really dug in to the bowels of the energy transition, and I have a piece coming out maybe in January. And I mean, deep investigative work on this, and my conclusion is what you're saying. Here's the deal. Here's the driver. The driver is density. Renewables cannot supply the density required for baseload. You can add battery storage to it, and fine, renewables start replacing some coal. Okay, so that's a temporary thing, whatever that means, you know, whether it's 5 years, 10 years, 15, 20. But yes, fossil fuels are needed, required. God knows what technology will happen to make them even more efficient. You know, fusion, we don't know how long that's going to take, but that is very much an answer. So I find it really, really interesting that they would announce this as there's all this green chatter, which I've been kind of talking about in some of my videos on Seeking Alpha. I've been addressing this. I've been saying what you're saying, basically. And so it's a big rethink, and a lot of people don't want to hear it. But yeah, watching where the money flows for reals and what the players are doing for reals is what matters. And it's probably the only way you can navigate these waters, you know. That's just my take.
That's great. Thank you.
Could I ask Jennifer what natural gas investment she's looking at?
Yeah, I mean, I haven't done a new sweep, and I need to, but I have a lot of US-based natural gas producers, and I like the ones that are both Permian and Haynesville at present, because there's now Marcellus stuff's great, and I've got some of that, but there's some bottleneck issues related to the pipelines, the ability to get the Marcellus gas to the Gulf Coast for export. So I'm more weighted towards the Haynesville Permian natural gas. But then here's the deal. You know, all these Permian players, now Permian is where it's at on oil and gas production, because you get all this associated gas connected to the, you know, oil production, right? So that gas also gets utilized, goes to the Gulf Coast. TEL is interesting. You know, and I think Tyson's talked about them before. Energy Transfer is interesting because of their amazing pipeline coverage. And, you know, they're getting an LNG plant back. You know, it went from a brownfield facility, and they're turning it into an export facility. So there's a lot of capital moving into this space that's really showing what's really happening. And there's a lot of LNG that's going to be moving around the world. But also, I mean, in Europe, they have choices. They could exploit some of their own natural gas resources. And the country that could do it the most easily would be the UK. But they're not leveraging at present their onshore resources. And actually, they would save a ton of emissions if they would do that. LNG is, you know, more resource intensive. So that's what I'd say generally.
Well, give us some names. I know you like Katera. Like,
yeah, you know,
what natural gas names do you like here in the US? And then comment on TEL. I liked it. They didn't get a financing. It's been a big disappointment, but I think that right now there's a compelling case, but I'm not sure whether they'll get their deal funded.
Yeah, well, okay, so I'm in Antero, I'm in Comstock, Katera. I'm not in TEL, but I'm, you know, I find their outlook and their, you know, discussions interesting. I just heard them talking at the Fed conference, and so it's a recency thing. I could look really quick at what I've got. Hang on.
No, I think that's great. Any other questions? Mike Zeldin?
I have a question, Tyson.
Go ahead, Walter. I'm sorry.
This is for
Another
anyone. No.
pedigreed investment manager. Go ahead.
Has anybody done any work on liquid steel batteries?
No.
Okay. I suggest, Jennifer, you probably, it seems like you do a lot of good research. You should look into it.
Yeah, I mean, yeah, there's
lithium, lithium,
these plays.
lithium is worse than coal in its own way, as you know.
Yes,
We're not going to get anywhere on that.
no, I agree.
And yet that's what everybody's planning. This liquid steel is quite intriguing. My memory is so bad, but I mentioned a couple of times ago about these two guys who were very early in understanding how completely destructive it was to put money into windmills and solar. And they had a little conference, I don't know, 3 or 4 weeks ago. And they had this guy who's the liquid steel genius on, and it's very exciting.
Yeah, and there's also the, isn't there some iron ore battery tech too?
That's what I'm talking about. I think.
Oh, okay, well, so, yeah, I have read about that some, and that would be a better thing, right?
Oh, much, infinitely.
Yeah, so that stuff's gonna happen, right? But people need to be aware, you know.
Well, this guy's working on it, and he's being very secretive. Jeffries actually met with him, I guess, maybe 4 days before he was on this one program, and so you might be able to find the research there.
Okay.
Anyway, it's very intriguing, but it just all fits in. I mean, you know, this is the emperor without clothes. This is King Canute. The whole thing is ridiculous, and it's been obvious for a couple of years. I'm glad to hear more people now talking about it. But meanwhile, we're destroying the economy, and Europe is really destroying themselves. And as you say, UK, I mean, they refuse to frack.
Yeah.
Anyway.
You mentioned this liquid steel batteries. What are the names of the companies involved?
Tony, I don't know. I don't think there's one major group that's doing the work, and they're pretty closed mouthed. As I said, there is someone, it was just interesting. I had put in my memo box to look at something out of Jeffries. And then literally a week later, I'm in this program. Cost me $400. Now that's not what it used to be, thanks to inflation. But this guy gave the pitch, and he was very impressive.
And they might not even be public, right?
Oh, no, no, precisely. Oh, no,
yeah.
no.
So, yeah.
You know, I mean, these guys that in hydrogen, you know, I mean, that's maybe 30 or 50 years away. And don't get me wrong, I like the idea, Alan, that it means, but unfortunately, these wackos in the Democratic left and elsewhere, you know, they don't care. They want to do this anyway. They're doing it for the power, I think. And, you know, and they're paying off all their people, such as, you know, the teachers union and General Motors. I mean, it's mind boggling. And we've always had that issue, and it's less of an issue than it is in every other economy, but it's gotten to be real serious.
I've heard of this. But I'm not going to comment because I'm just not equipped, but I have a startup called Optima Process Systems. And the guy I describe as my visionary was talking about taking iron ore, and you can use it to generate an exothermic reaction. And he said that actually the science is already established. People hadn't looked there. And this was an area he would be interested in. And I could probably get some paperwork, and I'm glad to send that off to continue that discussion. But that is, you know, it's, I don't know whether I call it revolutionary, but it's certainly something very different that is viable.
It's wildly revolutionary and much more dense.
Yeah, well, and that gets to the idea of disruptive technology. We don't know what is going to end up disrupting some of the things that are going on. And frankly, I pray for some disruption, given the insanity on some
Oh.
things.
We all do.
Yeah. So,
Any
Tyson,
other questions?
I have one other thought.
Go ahead, Rich Gula.
I think this session has set a record of modern sessions for getting this far without mentioning China, which I think is pretty impressive. I have several Chinese national friends who are in touch with things going on there, and they think that this regime has got to loosen things up fast, so they have a lot of trouble. So my favorite stock is Futu, F-U-T-U, since I can remember the symbol. But look it up. It's a online brokerage firm that's got a pretty nice chart in the sense that it collapsed and it's based out, and it might be an interesting way to play, as well as there's several ETFs that get at this. But anyway, I love China.
yeah. By the way, I just did a Wall Street podcast for Seeking Alpha, and I actually talked about China 50% of the time. That's going to come out Saturday morning. And I talked a lot about China and with respect partly to oil and gas. But so.
Well, I think
The other thing,
interesting. There seems to be a lot of commentary right now that with this ending of zero COVID, that you could actually get a meaningful GDP acceleration, which I think is the world's second largest economy, would be very helpful if things are flagging here domestically, which I'm more inclined to accept. Some of these charts we're looking at suggest things are a lot better than what they should be.
also this morning, Bloomberg was reporting that Brazil is forecasting 2.5% to 2.7% GDP next year, which is pretty good by European and US standards. And I think that there's plenty of trade connections between the Brazilians and the Chinese. So maybe the old ETF for Brazil might be interesting.
Any other questions? Thank you, everybody. Very interesting call.
Thank you, Tyson.
I have a recording of this. If anyone wants to see it, I'll try to put it up on my YouTube channel, which I'm slowly working on, trying to get a little more modern here. But thank you for your time.
Thank you.
See you guys.
All right.